Hey there! Welcome back to Bull and Bill, where we break down the financial world one step at a time. Today we're covering something that's become one of the biggest trends in investing: ETFs, or exchange-traded funds. You might have heard about them but wonder what makes ETFs so popular and are they the right choice for you? ETFs have exploded in popularity because they offer a way to invest in multiple assets with just one click, saving investors time, money, and sometimes a lot of stress. Imagine this. You've got a list of companies you'd love to invest in, say, some big names in tech, healthcare, or even sustainable energy. But buying each company's stock individually, that's a serious time and money investment. ETFs let you do it all in one shot, like ordering a platter instead of individual items off the menu. Let's break it down. An ETF is essentially a basket of different assets like stocks or bonds designed to mirror a certain part of the market. It could follow a big market index like the S&P 500 or focus on a niche area like renewable energy or tech. The beauty of ETFs? They're traded on stock exchanges, so you can buy and sell them just like a stock throughout the day. And here's the big appeal of ETFs. They often come with lower fees than mutual funds. That's because they're generally passively managed, meaning they track an index rather than relying on managers to pick individual stocks, which keeps costs down. Not all ETFs are the same. In fact, there are several types, each serving different investor needs. Let's start with stock ETFs. These focus on stocks within an index, sector, or even a region. For example, there's the S&P 500 ETF, which follows the 500 largest US companies. Bond ETFs, these track bonds, offering more stability and often paying regular income. They're a great option for those looking to balance their portfolio with less risk. Sector ETFs, want to invest in just technology or healthcare? Sector ETFs let you zero in on specific industries without needing to pick individual stocks. International ETFs, these focus on foreign markets, helping diversify your investments globally. Commodity ETFs, these track commodities like gold, oil, or agricultural products, giving investors a way to gain exposure to raw materials without directly buying the commodity. ESG ETFs, perfect for socially conscious investors. ESG ETFs target companies with strong environmental, social, and governance practices. A quick history lesson. The first ETF debuted in Canada in 1990, and it tracked the TSE 35 index. But the real game changer came in 1993, when the US launched the S&P 500 Spider ETF, also known as SPY. To this day, it's one of the largest and most traded ETFs in the world. Since then, ETFs have become a go-to for all kinds of investors, from beginners to pros. Now let's address some common misconceptions. One big myth is that all ETFs are safe because they're diversified. While diversification generally lowers risk, not all ETFs are low risk. Some ETFs focus on high volatility sectors like tech or biotech and can see major ups and downs. Another common misconception is that ETFs are only for passive investors. While it's true that many ETFs are passively managed, there are also actively managed ETFs where professionals make stock selections, aiming to outperform the market. So, yes, there's an ETF for almost every investment style. Now let's look at how investors actually use ETFs in their portfolios. For someone just getting started, an ETF that tracks a broad index, like the S&P 500, provides instant diversification across many sectors. This could be a low-cost way to own pieces of hundreds of top companies in a single investment. Or take an investor who wants exposure to international markets but isn't sure where to start. International ETFs offer a great way to gain exposure to Europe, Asia, or emerging markets, all in one go. It's an easy entry point without needing to research each country's market individually. For those interested in sustainable investing, ESG ETFs are popular. For instance, some ETFs exclusively focus on companies with strong commitments to sustainability and corporate responsibility. It's a way to make a positive impact while also pursuing growth. Time for some quick myth busting. A question we often hear is, are ETFs better than mutual funds? While both can offer diversification, ETFs typically have lower fees, more tax efficiency, and the flexibility of being traded like a stock. However, mutual funds may offer active management and sometimes more stable performance. And another question, are ETFs a good idea for short-term trades? Generally no. ETFs are designed for steady long-term growth. So while they can be traded daily, they're often most effective in a buy and hold strategy. Let's take a balanced look at the pros and cons of ETFs. On the plus side, ETFs provide diversification. They're generally low cost and they're transparent. You can see exactly what's inside them at any time. Plus, they're more tax efficient than mutual funds due to the unique way they're structured. But there are downsides to consider. Some ETFs focus on narrow sectors or even on highly volatile commodities. These might not be ideal for conservative investors. And while ETFs are usually low fee, expense ratios vary, so comparing fees is essential. Here are some of the most popular ETFs in the market today. There's SPY, the S&P 500 ETF that gives exposure to the largest US companies. Then there's VOO, another S&P 500 ETF from Vanguard, which is popular due to its slightly lower fees. For those interested in tech, QQQ tracks the NASDAQ 100, which includes top tech companies. And if you're after a mix of dividend-paying companies, VYM, the Vanguard High Dividend Yield ETF, might be a great fit. These ETFs allow investors to tailor their portfolios with specific goals in mind. To wrap up, ETFs provide a flexible, often low-cost way to invest in a wide range of assets, from tech stocks to foreign markets to sustainable companies. They're a powerful tool, whether you're aiming for growth, income, or a combination of both. Thank you for joining us at Bull and Bill. Don't forget to like this video, subscribe, and hit the bell for more insights. And, as always, leave a comment if you've got questions. We're here to help you on your investing journey.